So I will say that in order for you to know the directional bias of the market, first of all, you have to know the market structure break. So if you identify the market structure break, this gives you the very direction of the market. So for example, we say that if the market has made a series of lower low and a lower high, like this, we say that this signifies that it's a downtrend move. Why so? Because it has broke this previous lower low. So the broken of this previous lower low signify that this one is a downtrend move. So if the price has broken our higher high like this, so we say that this one signify that this one is an uptrend, okay? So we say that we are trading a BPC. What is BPC? BPC is a breakout, pullback, and a continuation. So in any type of market structure, or in any market, you say that first of all we need to see which trend are we. So the first one is you have to see the break of the market structure. The second one is to see the pullback. So we come to trade the continuation. So in our methodology, we trade this continuation only. We don't look for breakout and don't look for this pullback. So we only trade where continuation start. So our continuation start at the area of liquidity. We say that if the price has broken the low or has broken the high, we anticipate that the price will come back either to this low to go up, or to this high, or to this high, and then continues going up. So it depends for the area of liquidity. Okay.
Yes. Yes.
Yeah. So area of liquidity is what matters the most. So you need to see the area of liquidity first before knowing where the price will come to take your entry. So for the beginning, we say that let's say we are in a downtrend move like this. Okay, like this way. We say that this one is a break of market structure. So we don't know if the price will come back to test this high or the price will come to test this low. So sometimes the price will come back to test this high as a strong resistance, but sometimes the price will come to test this low as support flip, and then it goes down. So it depends which one is our area of liquidity. Okay.
Yes.
So which one signifies that this one is our area of liquidity? We have only two criteria or two features that signify that this one is our strong level or this one is our area of liquidity. The first one scenario, or the first one criteria, we say that you have to see if the price has high traffic of price. When you say high traffic of price, we mean that the area where there is high number of touches. If you see that at the area there is much more rejections, let's say that the price has broken the low like this, but at this low there are high much rejections. Okay, so this rejection signifies that this one is our strong level. So the price will come back to test here and then goes down. So from there we anticipate to see at the lower time frame a price has been engineered the liquidity. I mean failed overthrow like this. Okay.
Yes.
So we anticipate the price will go back here and then goes down. I hope everyone understood what about the engineering liquidity. We say that engineering liquidity is something like this. Okay, like this. So we anticipate the price will come back to see here and then it goes up. Or sometimes we anticipate to see the failed engineering liquidity. Failed engineering liquidity is when the price do something like this. It means that this one is failed, then the price comes to drop, and then comes up again, then comes down. This is our entry. So this one is our failed engineering liquidity. Why so? Because at first we anticipate after this price will come back here, and then we take the sell trade, but it has broken the level. So this one could be our entry as a failed engineering liquidity. For the case of sell, it will be like this failed engineering liquidity like this. So the price will go back here and then goes down. Okay.
Yes.
So this is a failed engineering liquidity. But from there we say that the first thing in a market structure, we have to see if the price has been engineered. I mean, if the price has made a market structure break. So market structure, and not every market structure break signify that a trend has been shifted. Okay.
Okay. Yes.
So you have to be sure that which market structure or which breaker it will be valid for us to take the trade. So a breaker that is valid for us to take the trade is the breaker that has been, I mean, the levels that or low or high that has been broken impassively. The low or high that has been broken by the impassive candle is the low or the high, which we include it as a valid breakout. Okay.
Breakout. Yes.
So we have already talked about the first scenario or first criteria for the area of liquidity. We say that high traffic of policy, I mean of price, high traffic of price,
yes,
which means that we need to see a price as high number of touches in the level. But the second one criteria that we say that we need to see a price which has a high rejection, a candlestick which has high rejection, either caused by news or anything. This signifies that this is an area of liquidity, which means that that rejection is an area of liquidity. So from that rejections, we see that we need to see at the lower time frame a price has been engineered the liquidity. Hope I am understood.
Yes, yes.
Are you there?
Yes, we are here.
From there, let me show you some examples. How do we manage to take the trade in that scenario? Okay. First of all, we have a gold trade. We have a gold trade. We have a gold trade. We have this. You see this. This is our sale for the gold trade. Gold trade. Let's make clear. We have this trade from the daily time frame. Okay, from the daily time frame. So from the daily time frame, we see that we have this impassive breakout. You see?
Yes, I see it. Yes, passive.
This impassive breakout, right?
Yes, yes.
So this impassive breakout, this signifies that this one is our strong breakout, is our strong breaker. So we say that after this breakout, we need to see which area of liquidity we will consider is as our area of liquidity. We say that we have two scenarios. The first one is high number of touches, and the second one is a long rejection long rejection candlestick. So at these scenarios, which will be our area of liquidity? Can someone tell me which area, which area will be our area of liquidity?
The one with the one with the rejection.
Eh?
Up there. The one with the rejection.
Can you annotate? Okay, so from this rejection, we say that this one could be our area of liquidity. So you can put a line about this, or sometimes you can put a rectangle for this week. You can put a rectangle for this week. So you should know that this one is our area of liquidity. So I prefer to use more a line. Okay, I prefer to use line to this where the candle has been started. So this is where candle opening. So I prefer to use this. So from there, this is where I candle opening, and this is the area of liquidity. So I would be shift direct to the 1 hour time frame as a coordinated low time frame. As I said before that we're dealing with the time frame coordination. So what is time frame coordination? We say that time frame coordination is where the time frames do coordinate. How? Because how do time frame coordinate? We say that if you use daily as your constant time frame, you'll be shifted to the H1, then 15 minutes, then 5 or 3 minutes up to 1 minute. So if you use, let's say, weekly as your constant time frame, so we'll be shifted to 84, then 30 minutes, then 5 minutes or 3 minutes or 1 minute. It depends. So if maybe you use 4 hour time frame as your constant time frame, so you'll be shifted to 30-minute time frame, then 5 minutes or 3 minutes or 5 minutes. I hope you understand what I talking about. So from there,
yes, understand.
We're using this is our daily time frame as our constant. So in day time frame, we identify the area of liquidity and we identify the breakout of the market structure. Okay. So a structure has been broken impassively by this candle. So this low has been broken impulsively by this candle. So we anticipate the price will go up to this. So in this area of liquidity, we need to see a price has been engineered the liquidity. This is our confirmation. It doesn't matter to which time frame you found this, but we need to see this one. This one is our best confirmation for us to take the trade. So without this, the broker will kill you.
Yes. Okay.
So from there, you go to the 1 hour time frame. So at the price engineer liquidity? No. Is it? A price has not engineered, right?
Yes.
So you go to the 15 light. So in the 15 time frame, if the price engineer the liquidity?
Yes.
Has been engineered, okay?
Yes, I see it.
But
yes.
This one is not enough for you to take the trade. You need to shift direct to the another low time frame. Why so? Because we have this. You see this one? It seems like above you have another engineering liquidity.
Oh, yes.
Okay, so from there we can delete this line and this line. So we need to go to the 5 minute. So this is our 5 minute time frame. So at 5 minute time frame, for those who are using supply and demand, they anticipate to take the sell trade. Why so? Because there is a supply level here, okay?
Okay, yes.
Supply level.
Yes.
But this is not enough for us to take the trade. Sometimes you can have a supply level, but it will be broken. What we need to see here, we need to see a price has been engineered. Engineering liquidity is what signifies the shift of that run. Okay, so we need to see this structure in our level. Okay, so we not trade the zone, we trade the level. This is a zone, so we need to trade a level, not a zone. Okay.
Okay. Yes.
Not an area. This is an area. So an area and a level are different. They are different. They are quite different. So we trade a level and not a zone or an area. Okay. So so we are not using that methodology for supply and demand, so we cancel this. So we can go directly to the 3 minute time frame to see if the price has been engineered the liquidity. So what are you seeing here? We see that a price has been engineered, right? You see this one?
Yes.
Makes this sense. Engineering liquidity, for those who are using supply and demand, let's go to 5 minutes. You see, it is in a supply level, okay?
Yes.
But for those who are using supply and demand, they took their trade in the proximal line, I hope, at this. So there are some people left behind, okay? So,
yes, true.
But there is no confirmation. So this one is our best confirmation for us to take the trade, okay? So that's why we have managed to take this sell trade. So this above is your stop loss and this one below is your entry. So let's make a bar replay to see what's going on. You see? The price has made a touch and this one is our sell trade. So this is how I managed to take this sell trade for gold. You see this one?
Okay. Yes, I see it.
But,
it makes sense.
We have another re-entry in case you miss this one. We have a re-entry, okay?
Okay.
Can you show me the re-entry for this trade? Just to follow the principle. No. The first one, we need to see the breaker, impulsive breakout of the candle.
Oh, yeah. Okay.
Okay. We need to see the impulsive breakout of the candle. So the first one, breakout, this one. This one is impulsive breakout. Okay.
Yes.
A price has been creating a low. I mean a high, low, high, then come to break by this impulsive candle. So I will say that we need to see a price go to the high rejection price. So this one rejections could be our area of liquidity, right?
Oh, yes.
So let's make a, let's cut our chart here. So from there, this one could be our area of liquidity. So in a lower time frame, we anticipate to see the price has been engineered or has made a failure overthrow. It depends what you see in your low time frame. So this is 1 hour time frame. So where do we go?
15.
Yeah, so in the 15 time frame, what will you see in a 15 time frame?
Engineered liquidity.
Okay, a price has been engineered. So this could be our re-entry for the sale.
1 hour.
So in case
Yes.
in case you miss the first trade, this one can be your second trade. That's why I'm using this rejection.
Yes.
So you have the second, I mean, you have the first entry and then you have the second entry.
Second entry. Yes.
Do you understand?
Yes, I get it. Yes, I get it.
So where could you put your take profit? I mean, your take profit. Your take profit, the first take profit will be taken at this this breaker, and the second one will be taken at this low.
Yes.
Okay. So if the price, maybe you enter 3 positions, so you will be closing 2 positions and the left one to hold the position. That's why you see I'm holding volatility 10 for almost 2 months. You see it?
Yeah, I saw it. I saw that.
I hold it for almost 2 months up to now. Nasdaq, I'm holding for almost 3 weeks up to, no, 2 weeks. I'm holding for 2 weeks Nasdaq.
Wow.
You see that trade, right?
Yes, yes, yes.
Yeah, so this is how a little bit I'm doing. But this is the first example. Let's see another example. Let's say GJ, OGU, or GJ. Why do we manage to take the same trade for the GJ? This is GJ, okay?
Yes, yes.
This is GJ. For my trade, I hope you understand up to now.
Yes, yes.
Do you understand?
I see it. Yes, I see it. Yes.
Yeah, easy. And so this one, why do I manage to mark this area? Don't get confused. This is a high, it acts like a resistance. The price closes below. So after the price closes below, so we see that there is impulsive breakout. So this breakout, we see that this breakout has been, this low has been broken by the impulsive candle, okay? So there is a pullback made here. So we need to see at the lower time frame, a price has been engineered. Is it?
Yes.
So in a 30-minute time frame, wherever you go, you can see that this one, a level has been engineered, the liquidity. So this one could be our entry for the sale. That's why we managed to take the sale trade for the GBP JPY.
Why?
Another trade we see is what? Which trade? We have this. Which trade is this? This is NZDJPY, okay?
Yes.
This is NZDJPY. This is NZDJPY. Can you tell me here, I have a little question for you. Can you tell me why do I consider this breaker? Why do I consider this breaker and not this above? We have this
because
breaker,
down here
we have this break above. Why do I not consider this one, but I managed to consider this break?
Because the impulsive move down there.
Okay, yeah, because this break has been caused by this impulsive move or impulsive candle. So a price come back to the area where we have a, let me show you this trade. So the price has been come back to area where there is high number of touches. We see that at this area, there is no weak rejection above, okay?
Yes.
But we have an area here which has high number of touches, okay? So from there, there is high number of touches, but the price has been engineered the liquidity. That's why we managed to take this same trade. You can make a homework for you or a back test on your own. Oh shit.